Hello guys, welcome to Bhavna's Online Academy. So in this video, we are going to learn the chapter 2 of SFM, which is your risk management. I have already uploaded the chapter 1. I'll try to link the playlist of the SFM series in the description box below. So you can check that out. And starting with this chapter, talking about this chapter is both a theory as well as a practical chapter. So there are also sums in this. So what we are going to do is we are going to make two parts of this chapter. This is the first part. In this first part, I'm going to cover theory, and in the upcoming part, which is the second part, I'm going to cover the practical sums. Okay, yes. So without any further ado, let's start with the chapter. And just before we start talking about the importance of this chapter also has been tested in almost all the past attempts for 4 marks. So a theory or a practical question for 4 marks comes from this chapter. So, and also since the number of pages of this chapter is also very less, so all the topics in this chapter becomes equally important. Yes. So now let's start with the chapter, guys. So first, so whenever you have a business, so whenever you run a business, your business is not always made to sail smooth. Okay, so there are going to be a lot of problems and a lot of risks that's going to arise in the business. So this chapter is particularly going to discuss of different types of risk that this business can face, as well as how can you mitigate this risk, or what are the various techniques by which you can reduce the risk levels. Okay, so this is what we are going to understand in this chapter. So the first topic is identification of types of risk faced by an organization. So what are the different types of risk that one organization or a business faces? So in our book, there are 4 kinds of risks that are given, which we are going to discuss now. Okay. Yes. So first is the strategic risk. So what does strategic risk means? As you understand from the name itself, every running business has one strategy. Okay, so today, even if I am going to start a business, I am going to have a strategy on how I want to become the market leader. What are the steps that I am going to take? Yes, so these are the strategies that make up a business. So what happens is that sometimes these strategies may also fail. So basically, a company's strategy may become less effective. Okay, so the strategy that you have made might not work out 100%. That is what is known as your strategic risk. So what can happen is that the best laid out plans can also become outdated if it cannot keep pace up with the latest trend. So if there is now some latest technology that has come up in the market, but I'm not keeping pace up with it, and I'm just, I've still holded on to the, our traditional technologies, then in such case, I might not be able to keep up pace with what's happening in the environment or what's happening in the world around me. And I might be left out, and my strategy of using the traditional technologies might not work there, which is again known as a strategic risk. Now let's discuss some real life examples for that. So we have 3 very famous examples that have faced the strategic risk. One is Kodak, then we have Nokia, and then we have Facebook. Okay. So Kodak, what happened was that it was using the films and the reels, right? Now what happened after a point of time, digital cameras came into picture. But Kodak did not adapt to this digital cameras or digital photography, even though Kodak was the company which created this digital photography at the first place. It thought this might not have a market, and it's only focused on the films and reels in the back days. So what happened? Other companies started adapting it, and they moved forward and they captured the market share, whereas the own inventor of the digital photography or that technology didn't adapt it, and it had to lose out on its market share. So here the strategy of Kodak miserably failed. The second example that we have here is of Nokia. So what happened was, when Android came into picture, the same way a new technology came into picture, Nokia did not adapt it. It did not keep up pace with the newer trends that were coming. So what happened? Other smartphone providers took over Android and became the market leader like Samsung, and Nokia couldn't pace up with it. So it caused a strategic risk, and Nokia also failed miserably. Then comes Facebook. Facebook also same way. What happens was, the new social trends it could not keep up with, and so it lost its leadership to Instagram. Okay. So these are the few examples of strategic risk. So strategic risk, what happens? You have a company strategy, but it becomes less effective, and due to which it struggles to achieve its goal. So what can strategic risk arise due to? It can be due to the technological changes, which is there in the case of Nokia or Kodak. A new competitor might enter into the market, example Instagram over Facebook, or we can also say Jio over Aircel. Then you have shifts in customer demand. So here what might happen is that Pepsi and Coca-Cola faced a strategic risk when the other competitors were providing healthier drink options to the consumers. Correct. Then as we moved on, the Pepsi or Coke, one of the companies I think have also now adopted healthier drinks in their segments. Correct. So that one. Then you have increase in cost of raw materials. That might also pose a strategic risk. You might have set up your unit in such an area where you would have thought that the raw materials might be cheap. That would have been a strategy you would have imposed so that your prices can be low and you can take over the market. But what might have happened is due to a few changes in the environment, your increase in your raw material cost could have happened. So that is also one of the strategic risks where your strategy could have failed. So this is what is known as your strategic risk, and this is the first risk that an organization can face. The second risk is compliance risk, where the company or the business does not comply with the rules and regulations that have been set up for them. Suppose all the companies have to comply with the Companies Act 2013. All the listed companies have to comply with the SEBI guidelines. Okay. So in case of non-compliance, what will happen? You will have to face penalties in the form of fine and imprisonment. Correct. So this is a compliance risk. When you don't comply with some things, you will have to compensate it with the you have to compensate it with the fines and imprisonment penalties. Correct. So here there are a few news letters which I have taken from the Google, which shows that when companies did not comply with the SEBI guidelines, what happens? So here see, SEBI imposes 2.3 crore rupees of fine on 32 entities for diverting IPO funds. So what happened was that these companies, they have deviated from the objects of the issue. Suppose what happens is that whenever you issue an IPO, there are a few objects that you state in your prospectus that these are the objects for which you're going to use the money for. And in case if you don't utilize that IPO proceeds for the reason stated in the draft prospectus, then in such case SEBI can impose penalties on you in the form of fines and imprisonment, right? So this is what has happened. So this is one risk to the company. So now the company's image would have been affected because of this. Correct. Yes. So that is compliance risk. So usually what happens is that compliance risk usually does not occur to businesses that have been running for a long period of time. It usually happens when you're venturing into a new business lines or a new geographical area because you don't know much about it. Suppose if there is a cement business which is venturing into a sugar business, that also in a different state, then all the rules and regulations of a new business will be different, plus the state might have its own rules and regulations too. So both you will have to comply. Correct? Yes. So that is compliance risk. So that is the second risk faced by the entity. Now the third risk is operational risk. So what is operational risk? As the name itself suggests, it is the risk which arises due to the day-to-day operations. In the day-to-day operations, people make some mistake, or there is a mistake in the process, or a problem arises that will lead to your operational risk. So operational risk usually an internal risk in the organization. Correct. So what might happen is the employee had to pay out someone 10,000 rupees, but they have paid out 1 lakh rupees. Okay, so this is one operational risk. Here you are losing on 90,000 of your money, and this can happen multiple times in your organization and not just one time. So what you can rather do is you can employ one person who is keeping a check. Okay, that what other person is doing. This is known as segregation of duties. Correct. So one person will do a work and the other person will check up. So you can keep that process. Or what you can do is you can install an electronic machine which will flag off an unusual amount, that to this person you usually pay 10,000 only. So in case any amount above 10,000, if it is given to the other person, then in such case your electronic system will itself flag off an unusual amount that 1 lakh rupees has been paid. Please check and review it. Okay. So what might happen is the people might also pose a risk, and in case if you do not have such process for the check or for the corrective mechanism, then your processes might also pose a risk in your operational. So one more example could be there is a financial service provider. Okay, what he did was he made an input error that instead of 10 lakh rupees, he had put $1 lakh. So what happens due to this, the client's credit rating can change from B to A. From a bad credit rating to a good credit rating, it could change, which will change a lot of aspects about the company, because a lot of grants, a lot of loans are given on basis of this credit rating only. Okay, and because of this one person's error, the entire environment of the company in large can affect its decision. Okay, the decision of the company's environment can get affected. Correct. Yes. So that is operational risk. So that is your third risk. And then your final risk, which can be faced by a company, is your financial risk. Financial risk means in the terms of money, what risk you can face. Okay. So unexpected changes in the financial conditions, like what can happen, your prices may go up or down. Your exchange rate might be adverse or favorable. Your credit rating might be changed. Your interest rate, what you are paying might go up, or what you are receiving might go down. So risks like these are known as your financial risk. So ultimately what will happen here is it is going to result in the financial loss of the company. Yes. So now here what has happened is they have divided this financial risk into 5 parts: counterparty risk, political risk, interest rate risk, currency risk, and liquidity risk. So they have given 5 subdivisions of financial risk. So starting with the first one, here they tell you that you have a risk from the counterparty, that is from the opposite party you have a risk. Suppose what you have did is you have given some loan to the opposite party, but now they are not paying that loan. So that is one counterparty risk. Another counterparty risk might be that you have already paid money to this party. In return that they would give you few goods, no, but they are not giving you these goods itself, but your money is already gone to them. That is one another counterparty risk. Okay, so what happens here is usually the counterparty does not honor their obligations. They do non-honoring of obligations. So in such case, it will be known as your counterparty risk. The next financial risk is the political risk. So here what happens is that this is usually faced by an overseas investor. For example, you would have heard that in India, TikTok was banned and PUBG was banned and a lot of other mobile apps was banned. Correct. Why did this happen? Did this happen because a company was doing something wrong? Was making a game like PUBG wrong, or was making an app like TikTok wrong? That was not wrong. But what happened here was that it was not because of the company, but because of the reason from where the company's roots were. Now, if this was a Chinese company, the roots of this was in China. What happened? The Indian government and the Chinese government had a clash, due to which the Chinese companies were being affected. This was not in a direct sense, but was in an indirect sense. So here the Chinese company is an overseas investor, that they are not in India, they are in overseas. They have invested in our country with their mobile apps and other things, but now they are facing an issue because of the Indian government. Okay, so here this Chinese company will be known as the overseas investor, and the Indian government will be known as your host country government. Okay, so India will be your host country. Correct. Yes. So here what might happen is an adverse action might be taken by the government of host country or India, which might lead to the huge losses, because so PUBG and TikTok, India was a very big marketplace. Now that getting affected is a political risk for them. Okay. So these are the different forms by which you can face political risk. What might happen is that if an outside foreign person or a foreign business has any property in India, the Indian government can either confiscate it or destruct it. Okay, so that might be one risk. Next risk is rationing of remittance to home country. So what might happen is there might be a Chinese company which is there in India. Indian government doesn't like China and Chinese company. Okay, so what they might do is they might put a restriction on this Chinese company, that this Chinese company can only send 40% of their profits to the home country, to their home country, that is to China. So like that, they are to the remittance that they are going to make to the home country, to the money that they are going to send to the home country or to China, the Indian government can ration on it, that this much only or this portion only you will be able to send. Another one way what they can do is they can make a restriction on conversion of local currency of host country into foreign currency. So China would have received all their revenue in Indian rupees. Now Indian government can pose a restriction on Chinese company that you cannot convert this into Chinese currency. Okay, you will have to keep it in INR only. So such restriction they can put. Next is restriction on borrowing. So usually what happens is a lot of companies needs fund to run their business. If the Indian government is not going to allow these companies to fund their business by the help of others, that they can borrow and take money, then in such case it will be very, very difficult for the company to run itself. Okay, so like that also the Indian government can do. Next, invalidation of patents. If there is any patent they have on their name, that also the Indian government can invalidate. And the final is they can keep a price control of products to help the the Indian government, to help the domestic players, they can put a restriction on this Chinese players that you have to keep a price above certain level. You cannot keep a product's price below 50 or below 20 or something like that, so that the domestic players are not getting affected because of this. So these are the different political risks which you can face. Okay, when you are investing or when you're going in some other foreign country. The next risk which comes under financial risk is your interest rate risk. So your interest rate going up and down can affect you in different ways. Suppose what you have did is this is you, okay, and this is one company. Suppose now you have given some loan to another company. Okay, suppose you have given money to another company and this is a foreign company and this is in China. Suppose you are in India. Okay, now when this company has to pay you back the interest rate, what happens is that the interest rate, suddenly you have fixed your interest rate on LIBOR or MIBOR rate, something which is an international rate and which keeps fluctuating. Okay, suppose if your interest rate has been kept in such a sense, and if your interest rate falls down, then the money that you're going to receive back as the interest on the borrowings, it is going to be less. And that could be a loss for you. Okay, the same and the vice versa can happen. It can make a favorable impact on you or an adverse impact on you also. So the change in interest rate resulting in change in assets and liabilities. Okay, mostly for banking companies. For banking companies, their main asset and liabilities is all depends on the loans and advances they give only. On the loans they get or on the loans they give. Okay, so for a banking company, their balance sheet items are more interest sensitive. Okay, so depending on interest, their value of assets and liabilities will also change. So due to this, there is an interest rate risk which has been posed on these banking company, because the banking company's base of income is itself borrowing and lending rates only. Okay, so depending on that only they earn. So because of that, the interest rate risk in banking companies is the highest. Okay, yes. Then there are two types of interest rate, fixed rate and floating rates. And because of that, what risk might come, you can read it in the para below. Okay, the next risk that you have is your currency risk. The next risk that you have is your currency risk. So here what happens is one currency might, the exchange rate here might fluctuate up and down depending on the market conditions, correct? Because it is a free flow of market. So here what happens, an organization which is dealing with foreign exchange, suppose their supplier is outside India or their customer is outside India. Here what happens, your cash flows are totally dependent on foreign exchanges only. So if there is a movement constantly in the foreign exchange rate, it can either adversely affect you or favorably affect you depending on how it is there for your host country, correct? Okay, so now taking an example, if your Indian rupee is going to depreciate in terms of US dollars, what is going to happen if you are an importer, okay, and you have to pay someone in US dollars, and now if your rupee has been depreciated, that your rupee value in terms of dollar has gone down, then you will have to pay them more, correct? And that is a liability for you. The same way, if you have to receive, you're going to receive more. Okay, so this is a currency risk which you can or your company can face. So here what can happen, Infosys is the best example that could be is that Infosys is an exporter. Okay, it gives its services outside India. So it can face currency risk. The same way Indian Oil Corporation Limited. Indian Oil Corporation Limited is an importer. So they can face a currency risk too. Okay, so these are the two biggest examples that we can take in terms of running businesses currently in India. Okay. Yes. Now talking about your final financial risk, which is your liquidity risk. So what is a liquidity risk? Liquidity risk is that in terms of money, you don't have any money. Okay, when you have to, 1 minute. When you have to pay out money to someone, or when there is an liability that you have to meet, if you are in the position of inability, that you cannot meet the liabilities that you have to pay or that has become due right now, then such thing will be known as a liquidity risk. That right now in our organization, there is no cash to meet the liabilities which are due. So organization is unable to generate adequate cash. So what happens? There is a mismatch in period of cash flow generation. So here what happens is that right now you have to pay something. For that right now you do not have money. Maybe in the future you can get money. So that is a mismatch of cash flow generation. Now if you have to pay something, now only you have to get money, right? If there is a mismatch in that, or if you are not able to generate adequate cash, then that will be known as your liquidity risk. So it is more prevalent in the banking business, because a lot of people, what happens is that they might not give their fixed deposits now itself. They might create it in the future, or if they have to repay some loan, they might not repay it immediately. They might do it in future, whereas you might be thinking that today if they repay this, we'll be able to lend someone the other money. But if that does not happen, then that is the liquidity risk. Correct. So these were the 5 types of risk under financial risk. So what we have read until now, can we just summarize it? So we had seen that businesses face risk. There are 4 kinds of risk that a business or an organization can face. The first one is strategic risk. Then you have compliance risk, operational risk, and financial risk. Under financial risk, you have again 5 types of risk. The 5 types of risk, one is political risk. 1 minute. I'll just read through from there. It's if I don't remember the order exactly. Yes. You have counterparty risk, political risk. Then you have interest rate risk, currency risk, and liquidity risk. So these are the 5 types of risk. So hope the risks is clear until now. Okay. Any doubts until this? Can we move on to the next part? Okay, fine. So moving on to the next part is evaluation of financial risk. So what happens? A company might face financial risk. Okay. But there might be different point of views from which you can see this financial risk. So here they have given you 3 point of views by which you can see this financial risk. First is the stakeholders point of view. Someone who is transacting with the company, what kind of risks that they can face. So talking about the biggest stakeholder of a company is the equity shareholders, people who have invested in your company through equity. What might happen is there, if your financial gearing ratio, that is the ratio of your debt in capital structure, if your debt in capital structure is going to be more, what will happen? When the company is going to be winded up, or when the company is going to get liquidated, equity shareholders are going to be paid at the last. And if there is a lot of borrowings, it might so happen that in the event of winding up, all the money that the company has goes into the hands of the borrowers, okay, who have, lended to your company, the lenders, and the equity shareholders might be left with no money. So this is one point of view that a stakeholder of a business might have. So this is a financial risk for the equity shareholders, a company having a lot of borrowings or loans. The second perspective is from the company's perspective. Okay, if the company is going to borrow excessively or lend to someone who is going to default in the future, then it might be forced into liquidation. But because at the end, if it is going to borrow a lot of money, it has to repay a lot, and it has to pay interest of a huge amount, and it might not have the sufficient money to do that. The same way, if it is going to keep on lending to someone who is not going to repay it, or someone who is going to default, then it might be left with no money. So it might be forced to go into liquidation. So from a company's point of view, that is a financial risk. Now next is from a government's point of view. So what might happen is that failure of any bank or downgrading of any financial institutions leading to spread of distrust among society at large. Okay, so if there is any risk, okay, like if there is a bank and the people who has to repay to the bank are willfully defaulting all the time that they have to pay, and there are a lot of defaulters in the bank, then it might cause the debt crisis on the bank itself. Okay, so this might be that from a government point of view, if there is any bank who is like caught up in this debt crisis, it is a financial risk, correct? Because that will then affect the society at large. Okay, yes. So these are the 3 point of views in terms of financial risk: the stakeholders' point of view, the company's point of view, and the government's point of view. Okay, yes. So I hope this is also clear to you all. Okay, yes. Now moving on to the next area, which is value at risk. So this is one area from where your practical problems can be asked. Right now, we are only going to discuss the theory aspect of value at risk, which is also equally important as much as your practical aspect is. And after that, in the next video, we will discuss the value at risk sums. Okay. So what is value at risk? Usually, whenever you are going to invest your money somewhere, whenever you are going to invest your money somewhere, it will have a risk in itself. Okay, it is not always 100% safe. If you are going to invest your money in equity, it is going to hold a risk. If your money is going to be invested in mutual funds, it is going to hold a risk. Okay, so wherever you invest, you are going to have a risk. So measuring of this risk of investment is what is known as value at risk. It is a measure of the risk that you're going to have on your investment. So it is basically nothing but measuring your risk in monetary terms. In rupee terms, how much risk are you going to face on your investment is what is value at risk. Okay, so here let's take an example. Suppose you have a portfolio of 10 crore rupees. You have invested in different aspects or different areas, and you have a now portfolio of 10 crore rupees. Now, if I'm telling you that with 99% confidence, that with what? With 99% of confidence, I can tell you that in the 1 month, in the upcoming month, your value at risk is 2 crore rupees. That means what it means is that it basically means that in the 1 month, the maximum loss that you can face is 2 crore rupees for the portfolio of 10 crore rupees that you have. And this I'm telling you with 99% confidence. That means there is a 1%, 1 minute. So there is a 1% chance of it being more than 2 crore rupees. With 99% confidence, I can tell you that in that 1 month, you will only have a maximum loss of 2 crores. That means with 1% of it being a chance that it can be more than 2 crores. Okay, so this is what is basically VAR, or what we say as value at risk. You basically determine the maximum loss you can have in that investment in a given period of time. So basically, given the normal market condition, in a set period of time, how much is the maximum loss that you can have, or how much an investment might lose? Okay, in a set period of time, it can be for 1 day or 1 month or 1 week or 10 days, depending on the time period that you have. Okay, how much can be your maximum loss? This is what is known as value at risk. Have you understood what does value at risk means? Any doubts in this? Can we move on to understanding the features of value at risk? Any doubts? Okay, fine. So I don't see any doubts there, so I'll continue. So now this was one question which was asked in July 2021. Okay, what are the main features of value at risk? It was asked for 4 marks. Okay. So basically you have to think now from the example that I told you, what are the components? The first feature is the components of the calculation. So what are the components that are involved in the VAR calculation? So you have a time period, say 1 month, 1 day or 10 days. Then you have a confidence level, that with how much confidence are you saying that this maximum loss can occur? It can usually be at 95% confidence or 99% confidence or 90% confidence. So these are the usually taken 3% of confidence level. Then loss in percentage or in amount, what you're going to determine. Okay. So this is what is known as your components of calculation, and this is the first feature of value at risk. The second feature of value at risk is that it is a statistical method. When we are going to do the sums part, now you will understand that even standard deviation is involved in this, involved in the calculation of value at risk. Okay, so this is a statistical method. The third is it has a time horizon, so it can be applied for different time horizons, 1 day, 1 week, or 1 month, and so on. The fourth feature is it is just a probability. It is a prediction that how much value of loss can happen. It is not certainty, it is a probability. Okay, and the fifth feature is that it is the risk control measure, that you can maximum set limits, that how much maximum loss you want to go for. It's first in the start itself, if you know this is a maximum loss that in 1 month you can make, then such controls you can take accordingly for the risk. Okay. And the final is Z-score. So Z-score is also what we are going to use in the calculation of value at risk. When we are doing the practical problems, you'll understand that. So there are 6 features of value at risk. First, you have components of calculation. Then it is a statistical method. It has a time horizon. It is a probability. You can take risk control. And then there is a Z-score. Okay, so if it is asked for 4 marks, you can write any of the 4 features and come in exam. Okay, then you have applications of VAR. Where can you use this value at risk concepts? Okay, in real life. So in May 2019, a question of 4 marks was asked from this. So VAR where you can apply, that is value at risk concept, where and all you can apply. You can apply in any of your portfolio trading position where you want to measure the maximum loss. So if you have a portfolio, and from that, if you have a portfolio, and from that, if you want to determine what is the maximum loss, in that you can apply this concept. The next concept is that you can keep it as a benchmark for performance measurement. That means if you have 2 mutual funds, mutual fund 1 and mutual fund 2, and in both of this, if you're going to only put 10 crores each, then using this VAR concept, you can apply and find out what is your maximum loss in both the mutual funds, and you can see what best suits you and how much risks you can take from that. So it can be used as a benchmark for performance measurement between the 2 mutual funds also. Okay, then it can fix limits for individuals dealing at front office. So at a treasury department with law, what is a fixed limit of risk or fixed limit of loss that can save them? Okay, that they can face. Okay, then it can help the management to determine the trading strategy. So now that you know what is the maximum loss that can happen in each of the items of your portfolio, it will help you in preparing what strategies, where you want to invest more, where you want to invest less. So depending on that, you can come up with your own trading strategies. And the final application can be used for asset and liability management, especially in banks. Okay, so what are the 5 applications? First is you can determine the maximum possible loss for your portfolio. It can be used as a benchmark for your performance management. An individual can know and fix their limits. The management can use this to fix their trading strategies, and it can be used as asset and liability management in bank. Any doubts in the VAR concept? So this was all about VAR, or what we call as value at risk. Okay, can we move on to the next topic? Any doubts? So I think we can continue. Hope my voice is audible and you're able to see the screen. Yes. So now moving on to the next topic, which is appropriate methods for identification and management of financial risk. So we already read that there were 5 types of financial risk, correct? Now what they have did is they have taken 4 categories of such financial risk. Out of the 5, I think they have taken counterparty risk, political risk, interest rate risk, and currency risk. They have left out the liquidity risk. So for these 4 risks, what are the ways by which you can manage these risks? We have understood what these risks are. Now we are going to understand how can you manage these 4 types of risks. Okay. Starting with the first one, which is a counterparty risk. This was asked in December 2021 examination. And the question was, which type of risks covers the default by counterparty? It is known as the counterparty risk. List out the ways to manage this type of risk. So you had to now write down what we are going to study now. Okay. So first, let's study what are the hints that may provide counterparty risk. From what can you know that this is a counterparty risk? So in exam, what they can give is they can give one of these hints, and they can tell you that what is this hint related to, which risk is this related to. Okay, and then they'll tell you what are the various techniques to manage this. Please tell us. Okay, so first is that what the counterparty risks hints can be that you have failed to obtain necessary resources to complete the project or transaction undertaken. Okay, from the counterparty, there was a project, okay, or a transaction that had to happen, but from the counterparty you did not obtain necessary resources. Suppose the counterparty had to give you some money, that was the transaction that had to take place. Now from that you did not take a written representation or something which is a signed or an agreement that they will have to pay you before this date. So what they are doing is now they just keep on extending the payment and they are not paying you back. So such failure to obtain resources to complete the project or transaction is a counterparty risk. Then regulatory restrictions from the government is also a hint to a counterparty risk. That what might happen is that government may suddenly tell that, Chinese government may suddenly tell that from today you cannot send this much bulk of money to India. There is a restriction of sending to money to India. Now if they have to repay you, they'll not be able to send you the entire money at once, right? So that is a regulatory restriction from government. Next is hostile action of foreign government. The same way, action this year it talks about how your host country can put a restriction, and here hostile action of foreign government means that the foreign government can take an action which can again affect your counterparty at some way. Okay, so these are both government related. Third is let down by third party. That is, the third party itself is directly letting you down. Okay, there is no third person involved, but the counterparty itself lets you down and they do not honor their obligations. And the final is that the third party has become insolvent. After that, what are you going to do? The person who you are doing business with itself is not there now, or is completely insolvent. So that is another counterparty risk. So hints that may provide counterparty risk are these hints. Okay. Now, what are the various techniques by which you can manage it? What are the various techniques by which you can manage it? Is first we told that we did not obtain necessary resources, correct? Now here you can carry out due diligence. You can examine the counterparty properly before doing any contract or before doing any agreement or before doing any transaction with them. So that will help you in decreasing the counterparty risk. Next is you do not overcommit to a single entity or a group to connected entity. So with one single party itself, don't make the entire contract or don't commit completely. Okay, or to a related group itself. Try to invest in different people or different companies and try to have different transactions with different types of entities. You should also know your exposure limit. Always know that there is going to be risk involved. You cannot completely mitigate it, but know how much can your risk limit or how much your exposure limit is. So that according to that, you make your transactions to your counterparty. Next is review the limits and procedure for credit approval regularly. So if there is any credit approval that had to take place, okay, that is from for that counterparty, okay, just keep always reviewing whether how is the procedure of credit approval growing, or what are the limits they are set up to, so that you understand about that entity's nature. Okay, depending on if they are a good company, the credit approval process is going to be really easy for them. If it is not, then they are going to face a few issues. So have a review or a check on that also. Then next is rapid action in the event of any unlikelihood of default. If there is a first time itself they make a default, okay, don't wait for the second, third or the 10th time for them to make a default. In the first time itself, take a quick action so that you're able to mitigate your risk. Next is the use of performance guarantee insurance or other instruments. So in case if there is any obligation that the counterparty had to perform, in case if there is any default, if there is no insurance or no backup or no guarantee that you have taken in place of that, just take an insurance that if they default, the insurance company will bear it, or if they are defaulting, some other person is going to guarantee it instead of the the counterparty, okay, or the foreign party. So you can use such performance guarantee or insurance so that you are able to mitigate your counterparty risk. So these are the various techniques: carrying out due diligence, do not overcommit, know your exposure limits, see the procedure for credit approval, likelihood of default. If it is happening, then take a rapid action, use performance guarantee or insurance to cover yourself. Okay, so this was the hints and the various techniques of counterparty. Next is political risk. Okay, So here also first they have given you a few hints and they have given you ways by which you can mitigate it. So actions by the government of host country or by India, this risk can be identified. Okay. So what can India do is India can keep insistence on resident investors or labor. So they can tell that if there is any foreign company which is coming in, they can tell that the labor should be from India only, or the investment that you're going to take should be from India only. Now people who are giving from India may lend you at a higher rate also. Okay, so this is a political risk that you can face due to the government. Next is restriction on conversion of currency that we have discussed earlier itself. Then expropriation of foreign assets by local government. So the the local government can take your possession from the assets that you have. Okay. So if there is any foreign assets that you have brought into India, the government can take your possession from that. Okay, so that can happen because they might have a restriction that you cannot bring in foreign assets. You have to use the assets made in India or from India only. Okay, then price fixation of products also we have discussed earlier. So these are the different risks which can be known as your political risk. So how is your company going to mitigate it? The techniques by which it can mitigate it, I'll tell you. But before that, let's see how your company should assess another company. So before you are investing in another company, another country, or before you are starting a business in another country, there are a few things that you have to keep in mind. So today, if I'm planning that I want to start a business in US, before starting a business in US, there are a few things that I should assess about US before investing or before starting up. So what are those different types? How can you assess whether there is a political risk or not? You can see the political ranking of the country, which is published in different business magazines. How is the political ranking? How good it can be if you start a business there or not? Okay. Next is you can evaluate the current country's macroeconomic condition, whether the country has a rising amount of inflation, whether it is nearing to any recession, or whether the government stability is not good there. Suppose analyzing the popularity of current government and their stability, how stable are they? Whether they are too much like like India, where they always say make in India, grow in India, or whether they are open to other foreign investors and foreign people too. Okay, then you can take advices from the embassies of the home country. So in your home country, there will be an embassy which is set up. In US, there will be an Indian embassy which is going to be set up. So from that Indian embassy, you can take point of view that how it is good, whether your kind of business can be started there or not. Okay, so like these you can assess. Okay, then in case even if you have assessed those, and after assessing also there is a few risks that you're facing, then the following risk you can take in order to mitigate or reduce that risk. Okay, so usually what happens is that now if you take Indian government also, if there is a Chinese company that is coming into India, they'll be very supportive to that Chinese company if they are locally sourcing the raw materials and labor. Because what happens is if you're going to locally source the raw materials, then to the local suppliers you're giving them a livelihood. The same way to the local laborers you're giving them a livelihood. Then in such case, the Indian government will not pose any action on you. Okay, then entering into joint ventures like Hero, Honda, Maruti, Suzuki, like venturing into or joining hands with the Indian company so that you understand the local government. So because they understand the local government very well and the rules and regulation also very well. Then is local financing, taking money from India itself so that the company cannot throw you out because you have to pay back to India again. And then prior negotiations itself you can have with the local government so that you don't face any problem in the future. Okay, so this was all about political risk. Now next, talking about the Indian interest rate risk. So how do you identify if there is an interest rate risk? Okay, you can check the monetary policy which is given by the government, that how your interest is going to go up or down in the future. Any action that is taken by the government like demonetization can also affect your interest rate risk. So just keep a check on what different kinds of actions the governments are taking. Depending on the economic growth of the country, whether it is very slow or very high, depending on that also your interest rate will fluctuate. Now, suppose in a country like US, which is very well developed, the interest rate is very, if suppose you are going to give someone money, or if you're going to suppose have a FD in the bank of a US bank, then in such case, the interest that you're going to get on it is going to be very, very low. Okay, because the government does not want people to deposit there. People want to give, because the government there want to give people more purchasing power. So depending on the economic growth of a country, also the interest rate might change. Next is release of industrial data. So what in your industry itself, there might be different companies operating in your other countries. Okay, there you can see what is the kind of interest rate which they are going on with. How is the lending and borrowing rates? Investment by foreign investors. Okay, so if there is any foreign investor that is coming for investment, what is the compliances that they have to come up with? If there is a lot of compliances, because a foreign person might give you a lot of interest, a lot of higher interest rate, okay, than that you're getting in your local part. But check what are the compliances that they have. So depending on that also your interest rate risk. If there is a lot of compliances that the foreign investors they have to make, they'll not do it. They'll just go away from that country. So depending on that also you have to check it. And then finally stock market changes also you can take help of to determine your interest rate risk. Okay. Yes. So these are the following ways by which you can identify what your interest rate risk can be. You can assess all of these. Now, how you're going to manage this interest rate risk is dealt with on a separate chapter, and there we will understand how do you manage your interest rate. There is interest rate management. There's a chapter of in that we are going to learn. Okay, then finally you have currency risk. So how you can identify your currency risk, we are going to understand now. Okay, so I hope until now you have understood. I'll just take a pause so you're able to take all of it in. We discussed counterparty risk, we discussed political risk, we discussed interest rate risk, and now we are finally on to our currency risk. Do you need a 1 minute break to understand what we have gone through now, or can we continue with it? Because this is the last part of the chapter. This is the last part of the chapter, and with this the chapter is over. Do you want to pause here, or we can complete and then you will go through? Okay. Okay. Yes. So in case if you're feeling the video speed is too high, all of you can pause, replay the video and come back to this point, or just keep the speed a little slow. Okay. Yes. Next is currency risk. So what can happen is, how are you going to identify if there is a currency risk? You can see what are the government actions that they are taking. Okay. Because what happens is, usually the action that the government is going to take in any country, it is going to have an impact on the currency. Okay, suppose for example the UK government decision to divorce from European Union. So the UK government came out of the European Union, okay, which was known as a Great Brexit. Okay, Britain being exited, correct. So this what happened was it had made the pound to its lowest, okay, since 1980. So any government that any action that your government is going to take is going to have impact on the currency. Next is nominal interest rate. Okay. So here what happens is that this you're going to learn in the upcoming chapters of SFM. So now just understand that your interest rate will have a, what do we say, the interest rate that you are going to have is going to have an impact on your currency exchange rate. So because of that, that also there will be a, what do we say, that there can be a currency risk, okay, depending on your interest rate also. Next is inflation rate. Depending on that, your purchasing power will change, and depending on that, again your currency is going to have an impact. Then your natural calamities. So now any natural calamity will have a negative impact on your currency. Then if there is a war or anything like that, then that can also have a negative impact on your currency if your currency is not doing well in those areas. Then if there is a change in government, okay, and if its attitude towards a foreign investment it's not so good, then it can have again a negative impact. So these are the different ways by which you can identify the currency risk. Okay, one is the actions that your government is going to take, your interest rate, your inflation rate, natural calamities, war, and change of government. Now, how you are going to manage your currency risk is also something that you're going to read in the upcoming chapters of SFM. Okay, that you're going to read in the upcoming chapters of SFM. So I hope you understood this chapter. Just going through a quick review of the chapter again, we started by reading what are the different types of risks that an organization faces. We read about strategic risk, compliance risk, operational risk, and financial risk. Under financial risk, we read about 5 risks, which is counterparty risk, political risk, interest rate risk, currency risk, and liquidity risk. Then we understood what are the 3 different point of views by which people can see their financial risk. It is stakeholders' point of view, companies' point of view, and government's point of view. Then you have value at risk concept. We understood in that we understood the features of it and applications of it. Then we understood what are the different methods by which you can manage your financial risk, in which we studied about 4 areas: counterparty risk, political risk, interest rate risk, and currency risk. In which interest rate risk and currency risk, these two mitigation of risks was not given in this chapter, and it is going to be discussed in the coming up chapters. Yes. So I hope you understood the entire theory part very well, and the next video I'll see you with the sums of this value at risk. And in case if you like this video, please make sure to like, share, and also subscribe to the channel. And in case of any feedbacks or any comments or any doubts that you have, you can leave that in the comment section given below. And see you in the next video, guys. Thank you for joining in. Thank you.